Hello, welcome to Module 2. I'm just going to give you a few minutes of instruction and things to navigate and places where you might want to research to help you answer the questions. So if you click on Content in Blackboard, and you will find Module 2 will be made live Monday. Module 1 will be due tonight by midnight, Sunday, January 29th, and I think you've all posted your first week's post for Chapter 1 and your discussion. It was nice to read and to get to know about each and every one of you. So if you click on Chapter 2, I recommend that you read the Chapter 2 PowerPoint slide, read your textbook Chapter 2, and then answer the discussion post. So if you click on here, Module 2, this was your first discussion post, your Module 2. You'll watch the video, this video that I'm just doing now, read the PowerPoint, and then in your textbook on Chapter 7, or if you've just bought the online code, you look up Brief Exercise 2-1, you need to indicate the effects of a debit, a credit, and the normal balance of each of these 6 accounts. And that should become apparent after you have read the text. The next thing you need to do is go to Content, and you need to complete under Chapter 2 an Excel spreadsheet for journal entries. So you click on this one here, and you'll see that there are journal entries right here. The questions are on page 72, or if you're using the online textbook, it's BE2-3, BE2-6, which stands for Brief Exercise. As I'm reading the textbook, the first one, the 2-2, on page 77, 2-3, sorry, discusses journalizing transactions for Tage Oslo and invest $5,000 in cash in a small welding business. So if I click on this, you press OK. And I've given you an example on here. If you look in your textbook under page 66, which I've indicated here, you'll see this is an example journal entry. Someone has deposited cash. This is the reference number for cash, which you'll see from your textbook. Owner's capital increases with a credit. Cash increases with a debit. And these are the kind of things you'll get out of the reading. Equipment is an asset, and when it's debited, it's increased. We always do our debits first and our credits second, and credits are indented. If you look here, there's a little indent in the spreadsheet. So I've given you a template. So the first one here is for page 77, BE2-3, and then the next template is page 78, Brief Exercise 2-6. You need to complete these, the journal entries. And I will give you a quick example of what it should look like. So if you're on page 77, it talks about Tage Oslo. And what you would do is you would go in and complete the template. So I've got my answers here, but you would type in the date, June 1st. You can put whatever year it is. You know, if it's 2016, we could put that in here. And the month is, let's see what it says, June. And then the first transaction is June 1st. And you complete the answers. I'll just put this in. And how you write a journal entry is cash. The reference numbers for cash will be 101. And then you put $5,000 in here, which is a debit because the owner paid money in. And then the owner's capital is increased with a credit of $5,000, and then you write a description of Tage invests in his company. And then you'd find the reference number for owner's capital. You do this for both transactions. Okay, so you can look that up, do some research, and complete, and then you would attach it to the Blackboard account, and you'll get a separate grade. So you get a grade for this, and you will get a grade for the discussion post. So when you click on the journal entries, you see there's 20 points for the discussion and 20 points for the Excel. And then what you do is you just browse my computer and you attach the Excel spreadsheet that you've just created that I gave you as a template. Okay, so what I'd like to show you quickly is that I've given you a detailed PowerPoint slide, but I just want to walk through some of the slides. I've taken the liberty of just including a few of them. So let's have a look here, and I'd like to walk you through a couple of these PowerPoint slides. So we're going to describe how accounts, debits, and credits are used to record business transactions. Everything in a business that needs to get recorded has a debit and a credit from an accounting perspective. And sometimes we call this a T account. So here you'll notice we have debits on the left, credits on the right. And that's really the only thing that is true for debits and credits. Based on where the accounts are, where they are in the accounting equation, depends on whether one increases or decreases, and you'll find that out as you work through the textbook. This is called a double entry bookkeeping system. The debits must equal the credits. So when you're posting everything, make sure everything adds up correctly. An example here is one account. So this account, as you read through the text, the account name would be on the top, debits on the left, credits on the right. And for example, if this was a cash account, the name would be cash. To increase a cash account, you have to have more debits than you do credits. So debits increase cash, credits decrease cash, and cash is an asset account. So in this case, if this was cash, the 3,000 would indicate a payment, and the debits would increase a deposit. So in this case, I've got 18,000 and I've got 3,000 of credits. So my bank balance would be 15,000 on my cash, and then I would reconcile that to my bank account. So I'm just going through this at a high level so you can see. In this case, if this was my cash account, I'd have more credits than debits. So my balance would be negative 1,000. I would have an overdraft at the bank in this case. But, if this was a different account, it might mean different things based on where it is in the equation. Here, I would go through these and feel comfortable with them, use them, write them out, use them as a cheat sheet. An asset, to increase an asset, you debit it. To decrease it, you credit it. I just gave you an example of cash, but there's many other accounts that we will go through as we go throughout the semester. A liability, so assets equals liabilities plus owner's equity. The credit is an increase to a liability, like an accounts payable, wages payable, so on and so forth. So the owner's equity accounts, so here we have capital and drawings. To reduce an owner's equity account, we would debit it, so an expense would be a debit. In this case, an owner's drawings and owner's capital. So take a look through that. Revenues to increase a revenue. Most revenue accounts will really pretty much only have a credit in there, and until we get to the end of the year, which I will talk about later. And then an expense is usually a debit, which in here, when we spend money, we debit the expense. When we earn revenue, we credit the revenue. Remember, everything has a double entry bookkeeping system, so when we debit, we have to credit. When we credit, we have to debit. And I'll let you take a look through that as you go through the reading. Here's some more helpful cheat sheets for you. Another one when I first started, I would print this out and take a look. So this is in your PowerPoint slide. Another maybe helpful, debits and credits. This is, like, to be honest, the harder part of accounting and finance, because you're just starting off with this and it's like a whole new language. So read this as much as you possibly can. Here's an example of somebody who has just rented space in a shopping mall. And this will help you if you read this to answer the questions for the first discussion post. So she's got a business called Here It Is. A friend has advised Kate to set up a double entry system. Identify the balance sheet accounts that Kate will likely need to record the transactions. So assets equals liabilities plus owner's equity is a balance sheet equation. So she needs cash, a bank account, which is called cash. And the usual balance for that is a debit. Supplies, she may have like shampoos, sprays, things in a closet somewhere. Those kind of supplies that maybe she even sells would be a debit to increase supplies. She may have equipment like chairs, mirrors, all those kind of things. That would be a debit to her equipment. Liabilities, she might owe somebody some money, and these would be a notes payable or accounts payable. And if she invested money into her own business, she would have the capital. And the capital account is an equity account. And she would credit that, which would increase her owner's capital. So this just talks about the recording process. And the journal is the original book of entry. And I would like you to create those journal entries that I just showed you in Excel, just to show you how we impact the financials. What happens is we do journal entries, and then at the end of the cycle, we then create the financial statements. And we're going to walk our way through that in the first 3 or 4 chapters of this text. Here's a general journal. So there's lots of these in the book, so I'll just walk you through this one. But if you look, entering a transaction in the journal. So you're going to be doing this on September 1st. Ray Neal invested $15,000 in cash. So we debit cash, and because he owns the business or put money in, he got owner's capital. So we increased owner's capital, we increased cash. So therefore assets equals liabilities plus owner's equity. Each transaction verifies that. The next transaction, it says here that he purchased the computer equipment. So he reduced his cash with a credit here, and he increased his equipment. So there's the 7,000. Oh, sorry. And just other examples of journal entries. All right, so I'm going to leave you off here and just take a look at some journal entries. Look, you've got a much more detailed PowerPoint slide, and your textbook does a great job at explaining this. And I've just picked out a few questions and some slides to help you get started. When you go to Wiley, there'll be some questions for Wiley Plus, and you can also look at some of the videos that Wiley has created. So here's some examples of asset accounts: equipment, land, supplies, cash. Liability accounts: payables, wages payable, accounts payable, notes payable. Look at some of these. Eventually you should become familiar with all these accounts. Then we've got salaries and wages expense, revenue, drawings, and capital underneath the owner's equity. This is kind of a useful guide. All right, I'm going to leave you off here for this week. I look forward to seeing your posts, and have a wonderful week.